The market just did that thing again. It made you pick a side. Either you stack metal or you buy miners. Either you're safe or you're leveraged. Either you're smart or you're gambling. That framing is the trap. Because what actually happened is simple. The metals have been moving, the mining shares have been waking up, and the gap between the two is where the real money gets made, or where people get wrecked. And the loudest voices? They want you to believe one sentence solves everything. Physical always beats miners. That sounds comforting. It's also incomplete. You're here with us. Let's cut through the noise. First, we need to separate two completely different tools. Physical gold and silver are not investments in the normal sense. They're monetary insurance. They're the fire extinguisher in the kitchen. You don't buy it hoping the stove catches fire. You buy it because if it does, you're not helpless. That role is irreplaceable. If the currency gets debased, if policy breaks something, if the plumbing of the system clogs, you can't reconstruct sovereignty with an ETF. You either have metal or you don't. Now watch the pivot. Mining stocks are not metal. They are businesses that happen to sell metal. That means their value isn't just price, it's price minus cost. It's margin. It's reserves. It's management. It's the country the mine sits in. It's whether the balance sheet can survive a bad quarter. It's whether dilution eats your upside before the cycle even gets fun. So when someone says miners underperform, what they're really saying is most people buy the wrong miners at the wrong time. That's not a metals problem. That's a discipline problem. Here's the hard truth we need to say out loud. In real, secular bull markets, the right miners can absolutely outrun the metals. Not by a little, by multiples. We've watched it happen. We've held positions where an initial buy turned into a life-changing number. One of the strongest silver sector positions we've tracked has compounded roughly 44 times from the earliest entry. 44. Meanwhile, if you caught silver down in the nobody cared zone and held through the move, your multiple is still impressive, but smaller. This is the first clue. Metal moves like a tide. A well-run miner moves like a lever. And levers don't care about your feelings. They amplify. But we're not allowed to pretend the leverage is free. Because miners can also go to zero. That's the part the promo crowd skips. So we don't do the hype thing. We measure. And we manage risk. This is educational. We're not gambling. We're measuring. Now, let's talk about the misunderstanding that keeps people stuck. A lot of investors look at miners through the scar tissue of the juniors. The tiny exploration names. The drill results next week lottery tickets. Those names are where cost overruns happen. That's where a CEO prints shares like confetti. That's where politics shows up at the gate with a new tax and a smile. That's where a single flooded shaft can erase a year of forecasts. So yes, many miners fail to deliver. But that doesn't prove miners are bad. It proves selection matters more than exposure. Here's a metaphor that actually fits. Physical metal is the boat. Quality miners are the engine. The boat keeps you afloat in a storm. The engine gets you somewhere. But if you bolt a junk engine onto your boat, you don't go faster. You sink faster. That's why the phrase, just buy the miners, is as reckless as just buy the metal. We need both lanes. We need the anchor and the accelerator. And the question isn't metal or miners. The question is, what phase of the cycle are we in? And where is the crowd positioned? Because cycles have personality. Early cycle, people hate the sector. The best companies are cheap. Nobody wants to talk about it at dinner. Mid-cycle, the chart starts pulling attention. Money begins rotating in. Fundamentals start mattering again. Late cycle, this is where things get dangerous and profitable at the same time. This is where the junior market goes feral. This is where anything with gold or silver in the name gets bid like it's guaranteed to be a mine. This is where promoters crawl out of the cracks. This is where the public buys stories, not assets. And that frenzy? It's one of the cleanest tells that we're approaching a top. We're not there yet, but we need to know what it looks like so we don't get seduced when it arrives. Because the end of a metals bull isn't quiet. It's loud. It's irrational. It's your barber asking which exploration stock to buy. Now, one thing most people don't think about, tax. Depending on where you live, physical metals can get hit harder than equities. Equities often get treated more favorably. So when we compare metal return versus stock return, we need to compare net results, not just headline moves. This is not the exciting part of the story. It's still real. And if we ignore it, we misread compounding. Then there's the income piece. Most people think of metal as dead weight. No yield, no cash flow. Just sit there and wait. A quality miner can pay a dividend. And if you buy early, when the market is asleep, the yield on cost can become absurd over time. You might start with a modest payout, but if the stock price multiplies and the dividend holds or grows, your yield on what you paid can climb into territory you normally associate with rental property. That's not a promise. It's a mechanism, and mechanisms matter. But again, only if you pick correctly. So what does pick correctly actually mean? It means we stop buying tickers and start buying business quality. We ask questions most people avoid. What's their all-in sustaining cost? Are their reserves actually expanding, or are they shrinking with accounting magic? Are they issuing shares every quarter? Do they hedge their production so heavily that rising prices won't even help them? Because hedging is the silent killer. If a company sold forward a big chunk of its future ounces at low prices, they locked in safety and capped their upside. When the metal rips, the bank gets paid, not you. So we watch for it. We read the disclosures. We don't let a glossy presentation distract us. And then there's jurisdiction. This is the part that turns geology into politics. A mine can be world-class on paper and still be uninvestable if the rules can change overnight, if the government can rewrite the contract, if the community can block access. If the legal system can't be trusted, price is not the only risk. Where the mine sits matters. Now here's where people get emotional. They see miners underperform for months, and they conclude the thesis is dead. That's the market's favorite trick. It makes you quit right before the rotation. Short-term divergences between metals and miners are normal. Sometimes they persist long enough to feel personal. But over full cycles, fundamentals tend to reassert. Not instantly, relentlessly. And that's why we avoid the one-week verdict. We watch flows. We watch sentiment. We watch what the crowd refuses to own. Now, let's bring in the data that exposes the oversimplification. When critics compare miners to metals, they often cherry-pick a moment. Or they use an index when it suits them and ignore it when it doesn't. But over the broad move, the mining indexes have often beaten the metals. Not every year, not every month, over the cycle. If we look at a representative stretch of this bull phase, you can see something striking. If we put real numbers on it, it gets uncomfortable for the miners always lose crowd. In one watch stretch, gold was up around 65%, silver was up around 132%, and the big mining indexes, they were sitting roughly in the 150% to 160% zone. That's the aggregate, the average, the boring middle-of-the-road score, meaning even the lazy way, owning the basket, kept pace and in many cases beat the underlying metal. Now zoom in. When you pick the right operator, you're not just holding ounces. You're holding a machine that turns higher metal prices into expanding margins, and expanding margins into cash, and cash into buybacks or dividends. That dividend angle is the stealth weapon. If a miner pays, say, 2% today and the stock later multiplies 5 or 6 times, your yield on what you actually paid can quietly slide into double digits. That's how you end up with the weird situation where your silver exposure is sending you cash every year. Metal doesn't do that. Metal just sits there and waits for the world to wake up. And yes, this cuts both ways. In a broad equity panic, miners can get punched in the face even if the metal holds up. They trade on a stock exchange. They get shoved into the same risk bucket as everything else for a while. But that's also where the setups are born. Because when the selling is forced, quality gets dumped with garbage. And when the pressure releases, quality snaps back first, and it snaps back fast. That snap is what most people miss. They wait for confirmation, and by the time they feel safe, the easy move is already gone. Gold moved up strong, roughly in the mid-double digits. Silver moved even harder, well over 100%. And yet, the major mining indexes, they still push beyond gold's move, and in some cases, tracked right up near silver's strength. That's not a fairy tale. That's what leverage does when capital finally rotates into the businesses. And here's the open loop most people miss. The best individual miners can outperform the index, by a lot, but the worst ones drag the average down. So the average investor who buys a basket of random miners gets a mediocre experience and declares the whole category broken. That's like eating one bad meal and declaring restaurants are a scam. No, your selection was the problem. Now, if you're newer to this space, you're dealing with a psychological disadvantage. You didn't get to buy the metal at absurd levels. You didn't get the easy multiple. So you're looking for a way to catch up. This is where miners become tempting. Because a miner is essentially metal in the ground, often priced like it's worth pennies, until the market decides it's worth dollars. You're buying ounces at a discount, if the ounces are real and recoverable and not trapped behind politics, debt, or bad engineering. That's the game. And it's why the return can be violent. But it's also why you cannot do this asleep. We need a framework. We need to know what we own, why we own it, and what would prove us wrong. So let's lay down the trust framework in plain language. Fact. Metals can preserve purchasing power when currencies weaken. Fact. Miners can multiply returns because their profits expand faster than price. Fact. Many miners destroy value through dilution, mismanagement, or geopolitics. Interpretation. We need a blended approach, weighted by the phase of the cycle and our risk tolerance. Possible risk? If the broader equity market melts down, miners can get sold with everything else, even if the metal holds up. That's not fear, that's reality, so we plan for it. Now, here's the mistake most people make. They treat physical and miners as competitors. They're not. They're teammates. Metal protects you when the system breaks. Miners can grow you when the cycle runs. So we build the base first, then we add torque, and we keep it intentional. Because the end game isn't own miners forever. The end game is to use miners to acquire more real assets. Sometimes that means recycling profits back into physical. Sometimes it means paying down debt. Sometimes it means buying cash flowing assets when the world is euphoric and overpriced. The key is we don't let paper gains hypnotize us. We convert. Now, the timing question. Why are some silver investors suddenly looking at miners now? Because the macro backdrop is getting louder. Debt levels are ballooning. Trade policy is getting weaponized. Supply chains are shifting. Inflation isn't gone. It's just hiding behind selective headlines. And the value of cash gets drained in a way that feels slow. Until it doesn't. This is how resets start. Not with a siren, with a leak. And when people sense the leak, they look for hard assets. Gold and silver are the obvious candidates. But once the metal runs, attention moves to the leverage. That's the rotation. Metal first, miners next. And the last wave? The junk miners, when speculation becomes a public sport. So the fact that capital is sniffing around miners is not random. It's a tell. But we have to stay sharp because the same environment that produces massive winners also produces a swarm of traps. Let's talk about the traps. Trap 1, story stocks with no balance sheet. They have a nice map. They have a charismatic CEO. They have potential. But they have no runway. So they raise money. And raise again. And again. Your ownership gets diluted while the dream stays 2 years away. Trap 2, high-grade deposits in unstable regions. The rock is perfect. The politics are poison. You can be right on geology and still lose. Trap 3, companies that look cheap because the market is pricing in a problem you don't see yet. Maybe their costs are rising. Maybe their ore grade is rolling over. Maybe they have a debt wall coming due. Cheap is not a signal. Cheap is a question. We need to investigate. Now here's where we make this practical. If we're building a portfolio for a metals bull market, we want layers. We want the core, physical. We want the quality leverage, established producers, maybe a royalty style model if we can get it, and only the kind of balance sheets that can survive volatility. Then we want selective aggression, a handful of smaller names where the upside is asymmetric, but the position size is controlled. Because we do not bet the house on a drill hole. We measure, and we survive long enough to let compounding do its work. Now, I want you to notice something about narratives. Mainstream commentary loves clean slogans. Just buy the metal. Just buy the miners. ETFs are enough. Slogans are comforting. Markets are not comforting. Markets are a war for attention, and the people selling you slogans are often selling you simplicity, because simplicity sells. But we don't need simple. We need true, and true usually has tension. Here's the tension. Physical gives you peace. Miners give you volatility. Peace doesn't compound fast. Volatility can. So the question becomes, can we tolerate the path to the outcome? Because a miner can be up 300% and still drop 40% on the way there. That drop is where most people panic sell. That drop is where the transfer of wealth happens. And the system knows it. That's why the sector is designed to exhaust you. So we manage it with position sizing, patience, and a rule-based approach. We don't marry a chart. We don't worship a CEO. We watch costs. We watch cash flow. We watch share count. We watch jurisdiction. We watch the metal. And we watch the crowd. Now, before we close this loop, I want to hit one more lever people ignore, liquidity. Physical is liquid in the real world, but it's not click to sell. Mining equities are click to sell. That means when panic hits, they get smashed fast. And when greed hits, they get bid fast. This is why the miners can feel like a roller coaster, even when the metal feels calm. It's not because the thesis is broken. It's because the instrument is different. And if we understand that, we stop making emotional conclusions from normal behavior. Now let's bring it home with a warning. When this cycle gets late, the sector will start printing absurd gains. You will see names you've never heard of double in a week. Your feed will fill with next 10x clips, and the temptation will be to chase. That's when we need discipline the most, because late cycle euphoria doesn't reward skill. It rewards speed until the music stops. So we do our work before the mania. We build the base now. We pick quality now. We define our risk now. And when the crowd finally shows up, we're not scrambling. We're already positioned. Now I want to ask you something that will tell me where your head is. If silver rips higher, what will prove your miner is a winner? Is it rising margins? Is it growing free cash flow? Is it shrinking share count? Or is it just a chart that makes you feel good? And second question, be honest. Do you feel safer holding metal? Or do you feel frustrated because it doesn't move enough? Drop your answer in the comments. We'll learn from each other. One last thing before you go. This macro environment is not getting simpler. Debt keeps climbing, policy keeps improvising, and the average person keeps pretending a reset can't happen, right up until it does. So we stay prepared, we stay measured, and we stay ahead. Want more like this? Subscribe. When miners catch the bid, it's days, not months. Most people show up too late again.